What you're about to hear isn't going to be reported on the evening news. It won't make headlines on CNBC. And by the time the mainstream financial media catches on, it'll be too late for most people to act. But right now, in this moment, there's a seismic shift happening in the precious metals market that's being deliberately kept quiet. And the people who understand what's really going on are positioning themselves before the rest of the world wakes up. Let me ask you something. Have you noticed how quiet things have gotten about gold and silver lately? How the financial networks seem more interested in talking about tech stocks and cryptocurrency than the oldest forms of money humanity has ever known? That silence isn't accidental, it's strategic. Because while everyone's distracted, something extraordinary is happening behind the scenes. Central banks around the world are accumulating gold at a pace we haven't seen in generations. Not just buying it, hoarding it. And they're doing it for a reason that should concern every single person watching this video. Think about this for a second. When was the last time you saw a central banker panic? These are the most conservative, risk-averse institutions on the planet. They move slowly. They deliberate. They analyze every decision to death. And yet right now, they're buying gold like their currencies depend on it. Because frankly, they do. The global monetary system is showing cracks that can't be papered over with more quantitative easing or interest rate manipulation. And the smart money knows it. Here's what's really happening. Gold has broken through resistance levels that technical analysts have been watching for months. We're not talking about minor moves here. We're talking about sustained momentum that suggests something fundamental has changed in how institutional investors view precious metals. And it's not just gold. Silver, which has been called the most undervalued asset in the world by some of the sharpest minds in finance, is showing signs of a supply squeeze that could send prices into territory most people think is impossible. Before we go any further, I want to make sure you have access to information that could protect your wealth. I've put together a free guide in the description below that shows the saving secrets thousands of American retirees are using right now to protect their hard-earned wealth. It's completely free, and it could be the most important thing you read this year. Check the description after this video. Now let me take you inside what's really driving this market. The COMEX, which is the primary exchange where precious metals futures are traded, has been experiencing something unusual. Inventory levels have been fluctuating in ways that suggest major players are taking physical delivery rather than rolling over paper contracts. That might sound technical, but here's what it means in plain English. For decades, the precious metals market has operated largely on paper. Futures contracts, ETFs, certificates. Very few people actually took possession of physical metal. It was easier to trade paper promises. But something has changed. Suddenly, institutions want the real thing. They want bars and vaults, not digital entries on a screen. Why does that matter? Because the entire pricing mechanism for gold and silver has been based on a fractional reserve system. There's far more paper gold and silver trading than there is actual physical metal to back it up. It's worked fine as long as everyone was content to trade paper. But when people start demanding physical delivery, the system gets stressed. And when the system gets stressed, prices have to adjust to reality. That adjustment is what we're starting to see now. Let me tell you a story that illustrates what's happening. There's a major European bank, one of the oldest and most respected financial institutions in the world. A few months ago, they quietly started converting their gold ETF holdings into physical bullion. Not a small amount. We're talking about hundreds of millions of dollars worth. They didn't announce it. They didn't issue a press release. They just did it. And they're not alone. Sovereign wealth funds from the Middle East and Asia have been doing the same thing. They're moving out of paper and into physical metal. Now ask yourself, why would they do that? These are sophisticated investors with access to the best research and analysis money can buy. They're not making emotional decisions. They're responding to something they see coming. And what they see is a monetary system that's running on borrowed time. The dollar, which has been the world's reserve currency since the end of World War II, is facing challenges it's never encountered before. Countries are settling trade in their own currencies. They're building alternative payment systems that bypass the dollar entirely, and they're backing up those moves by accumulating gold. The BRICS nations, Brazil, Russia, India, China, and South Africa, have been particularly aggressive. China alone has been adding to its official gold reserves month after month. But here's the thing. The numbers they report are almost certainly understated. China has a history of accumulating gold quietly, and then announcing much larger holdings after the fact. They did it before, and there's every reason to believe they're doing it again. Why? Because gold gives them leverage. It gives them credibility. And in a world where the dollar's dominance is being questioned, gold is the ultimate form of monetary insurance. But it's not just about geopolitics. There's a fundamental supply and demand story here that most people don't understand. Gold mining production has been essentially flat for years. The easy gold has been found and mined. New discoveries are rare, and when they do happen, it takes years and billions of dollars to bring a mine into production. Meanwhile, demand is surging, not just from central banks, but from individual investors who are waking up to the reality that their paper wealth might not be as secure as they thought. And then there's silver. Silver is where things get really interesting, because silver isn't just a monetary metal, it's an industrial metal. It's used in solar panels, electric vehicles, electronics, medical devices. The green energy transition that governments around the world are pushing requires massive amounts of silver. And here's the problem. There isn't enough of it. Silver mining production has been declining. Existing mines are depleting. And the amount of silver needed for industrial applications is growing exponentially. That creates a supply deficit that has to be resolved somehow. And the way markets resolve supply deficits is through higher prices. Think about what happened in the nickel market a while back. Prices went absolutely parabolic because of a supply squeeze. Traders who were short, the market got destroyed. The exchange had to halt trading. It was chaos. Now, I'm not saying silver is going to do exactly the same thing, but the setup is eerily similar. You have a market where paper trading dominates, physical supply is tight, and demand is accelerating. That's a recipe for a price explosion. Here's something else that should concern you. The ratio between gold and silver prices has been historically out of whack. Throughout most of human history, the gold to silver ratio has averaged somewhere between 15 to 1 and 30 to 1. Right now, it's been trading much higher than that. What does that mean? It means silver is dramatically undervalued relative to gold. And when that ratio reverts to its historical mean, which it always does eventually, silver prices are going to move in a way that will shock people who aren't paying attention. Let me paint you a picture of what this could look like. Imagine you're a pension fund manager. You've got billions of dollars to invest, and your job is to preserve and grow that wealth for retirees. For years, you've been comfortable holding bonds and dividend-paying stocks. But now, bonds are yielding next to nothing after inflation. Stocks are at valuations that make you nervous, and you're starting to hear whispers that the monetary system might be in for a rough ride. What do? You start allocating to hard assets, gold, silver, real things that can't be printed or devalued by a central bank decision. Now multiply that decision by thousands of institutional investors around the world, all coming to the same conclusion at roughly the same time. That's not a hypothetical. That's what's happening right now. The flow of money into precious metals isn't a trickle anymore. It's becoming a flood. And floods have a way of overwhelming the existing infrastructure. The LBMA, the London Bullion Market Association, which is the other major hub for precious metals trading, has been experiencing similar dynamics. Spreads between paper prices and physical prices have been widening. That's a technical way of saying that people are willing to pay a premium to get their hands on actual metal rather than a promise of metal. And when premiums start rising, it's a signal that the market is under stress. Now, I want to talk about something that affects you directly, your retirement accounts. Most Americans have their retirement savings in traditional vehicles, 401ks, IRAs, brokerage accounts filled with stocks and bonds. And for decades, that's been the conventional wisdom. Diversify across different sectors, hold for the long term, and you'll be fine. But what if the assumptions underlying that conventional wisdom are wrong? What if the next decade doesn't look like the last decade? What if the monetary system that supported asset prices for your entire investing lifetime is changing in fundamental ways? That's not fear-mongering. That's risk assessment. And the institutions that manage the world's largest pools of capital are doing exactly that kind of risk assessment right now. They're looking at government debt levels that are mathematically unsustainable. They're looking at central banks that have painted themselves into a corner with their monetary policies. They're looking at geopolitical tensions that could disrupt the global economic order. And they're concluding that they need to own assets that have intrinsic value, regardless of what happens to paper currencies. Quick aside here. If you're sitting on $100,000 or more in retirement accounts, I've put together a free guide on how gold IRAs work. It's in the description. It covers how to get physical gold into your retirement account without tax penalties and how to protect your wealth from the kind of monetary instability we're seeing build in the system. It's worth checking out if you're concerned about market collapse, geopolitical instability, or the long-term value of paper assets. No obligation, just information that could be crucial for your financial future. Now, back to what's happening in the markets. Let's talk about the mechanics of how a precious metals price surge actually unfolds. It doesn't happen overnight. It happens in stages. First, you get the smart money accumulating quietly. That's been happening for months. Central banks, sovereign wealth funds, family offices, they're building positions without making noise. Then you get the technical breakout. Prices move above key resistance levels, and that attracts momentum traders and technical analysts. We're in that phase right now. The next phase is when the mainstream financial media starts paying attention. That's when you'll see headlines about gold hitting new highs. And that's when retail investors, the average person watching CNBC or reading the Wall Street Journal, starts to get interested. But here's the crucial part. By the time the mainstream media is talking about it, the easy money has already been made. The people who positioned themselves early, when everyone else was skeptical, those are the people who capture the biggest gains. The people who wait until it's obvious, until everyone agrees that precious metals are going higher, they're the ones who end up buying near the top and then panicking when there's a correction. I want to take you back to a historical parallel that's instructive here. In the 1970s, gold went from $35 an ounce to over $800 an ounce. That's not a typo. Gold increased more than 20-fold in a single decade. Why did that happen? Because the monetary system was in crisis. The dollar had been devalued, inflation was raging, and people lost faith in paper currency. They rushed into gold as a store of value. Now, I'm not predicting that gold is going to go up 20-fold from here, but I am saying that the conditions that drove that move, monetary instability, loss of confidence in fiat currency, geopolitical uncertainty, those conditions are present again today. In some ways, they're even more extreme than they were in the 70s. Think about the amount of debt in the global financial system today. Government debt, corporate debt, consumer debt. It's orders of magnitude larger than it was in the 70s. And that debt has to be serviced, it has to be paid back, or it has to be inflated away. There's no third option. Governments can't just wish debt away. They either default, which would be catastrophic, or they print money to pay it off, which devalues the currency. Either scenario is bullish for precious metals. Here's another angle most people aren't considering: the derivatives market. There are trillions of dollars worth of derivatives contracts tied to interest rates, currencies, and commodities. These are complex financial instruments that are supposed to help institutions manage risk, but they also create systemic risk because these contracts are interconnected. When one party can't meet their obligations, it creates a cascade effect. And in a world where interest rates are rising and currency values are fluctuating wildly, the risk of a derivatives blow-up is real. What happens when that occurs? People flee to safety, and the safest assets in a financial crisis are the ones that have no counterparty risk. Gold and silver, you own them outright. They're not dependent on someone else's promise to pay. Let me tell you about a conversation I had with a commodities trader who's been in the business for 30 years. He told me something that stuck with me. He said, "In all my years of trading, I've never seen the kind of urgency I'm seeing now from buyers who want physical metal. It's not about making a profit on a trade. It's about securing supply. They're worried that if they don't act now, they won't be able to get metal at any price later. That's not normal market behavior. That's crisis behavior. And it's not just happening in gold and silver. Look at what's happening in other commodity markets. Copper, which is essential for electrical infrastructure and the green energy transition, has been hitting multi-year highs. Lithium, which is needed for batteries, has seen explosive price growth. Uranium, which is required for nuclear power, is in a supply deficit. There's a pattern here. The world is waking up to the reality that we've underinvested in the production of physical commodities for years, and now demand is outstripping supply across the board. But gold and silver are unique because they're not just industrial commodities, they're monetary metals. They've been used as money for thousands of years, and when people lose faith in paper money, they return to what has always worked: That's not speculation. That's history. Every fiat currency that's ever existed has eventually failed. The dollar has lost over 95% of its purchasing power since the Federal Reserve was created, and the pace of that devaluation is accelerating. Look at what's happened to prices in just the last few years. Groceries, gas, housing, healthcare, everything costs more. Your paycheck might be bigger, but it buys less. That's inflation. And inflation is a hidden tax that erodes your wealth silently. The government doesn't have to raise your taxes explicitly. They just print more money, and the money you've saved becomes worth less. Gold and silver are the antidote to that. They can't be printed. They can't be devalued by a government decree. Their value is intrinsic. Now let's talk about what could trigger the next major move higher in precious metals. There are several potential catalysts. A geopolitical crisis that disrupts global trade, a banking crisis that shakes confidence in the financial system, a currency crisis where a major currency collapses, a policy mistake by a central bank that causes inflation to spiral out of control. Any one of these events could be the spark. And the scary thing is, all of them are plausible in the current environment. Think about the banking sector. We saw what happened when a few regional banks got into trouble. There was panic. Depositors rushed to withdraw their money. The government had to step in with emergency measures. Now imagine that happening on a larger scale. Imagine if people started questioning the solvency of major banks. Where would they put their money? Not in another bank, not in stocks that could crash. They'd put it in assets that can't go bankrupt, gold and silver, or think about the geopolitical situation. Tensions between major powers are higher than they've been in decades. Trade wars, sanctions, military posturing. Any escalation could disrupt the global economic system that we've all taken for granted. And in that kind of environment, countries hoard resources. They stockpile commodities. They accumulate gold. Because gold is the one asset that every country recognizes as valuable, regardless of political differences. Here's something that should really make you think. The world's wealthiest families, the ones who have preserved their wealth across generations, they've always held significant amounts of gold. Not as a speculation, as insurance. They understand that paper wealth can evaporate, businesses can fail, currencies can collapse, but gold endures. It's been valuable for 5,000 years, and it will be valuable 5,000 years from now. That's the kind of long-term thinking that builds and preserves generational wealth. And yet most people have zero exposure to precious metals. Their entire net worth is tied up in assets that are dependent on the continued stability of the current system. That's not diversification, that's concentration risk. And it's a risk that could prove devastating if the system experiences the kind of stress that many experts believe is coming. Let me give you another historical example. In 2008, during the financial crisis, gold was one of the few assets that held its value. While stocks were crashing and real estate was collapsing, gold was stable. And in the years that followed, as central banks around the world printed trillions of dollars to bail out the financial system, gold went on a massive bull run. The people who owned gold before the crisis protected their wealth. The people who bought gold during the crisis made substantial gains. The people who ignored gold altogether saw their purchasing power eroded by the inflation that followed. We're in a similar setup now, except the stakes are even higher. The amount of money that's been printed since 2008 is staggering. The debt levels are higher. The imbalances in the system are more extreme. And the tools that central banks use to manage the last crisis, lowering interest rates and buying assets, those tools are less effective now because rates are already low and balance sheets are already bloated. So what happens next? Central banks are trapped. If they raise rates too much, they'll crash the economy and trigger a debt crisis. If they keep rates low, inflation will continue to erode purchasing power. There's no good option. And in that kind of environment, hard assets become increasingly attractive, not just to institutional investors, but to anyone who understands what's happening. Silver, in particular, is set up for an explosive move. The industrial demand story is compelling on its own, but when you combine that with monetary demand, with investors viewing silver as undervalued relative to gold, and with the supply constraints I mentioned earlier, you have a perfect storm. Silver has a history of making violent moves to the upside when conditions align, and those conditions are aligning right now. I want you to think about your own situation for a moment. How much of your wealth is in paper assets? How much is in things that have intrinsic value? If the dollar lost half its purchasing power over the next few years, which is not an outlandish scenario given the amount of money printing that's occurred, how would that affect your retirement plans, your ability to maintain your standard of living? These aren't comfortable questions, but they're necessary questions. The mainstream financial advice industry doesn't want you thinking about these things. They want you to stay invested in the stock market, to keep buying bonds, to trust that the system will continue to function as it always has. And maybe they're right. Maybe everything will be fine. But what if they're wrong? What if the next decade is fundamentally different from the last decade? Can you afford to bet your entire financial future on the assumption that nothing will change? Here's what the smart money is doing. They're not abandoning traditional investments entirely, but they're allocating a meaningful portion of their portfolio to hard assets, to gold and silver, to things that will hold value regardless of what happens to paper currencies or financial markets. They're buying insurance, and they're doing it now, before the crowd figures out what's happening. The window of opportunity to position yourself ahead of the mainstream is closing, not because precious metals are going to stop being valuable, but because the easy entry point is disappearing. Prices are rising. Premiums on physical metal are increasing. Supply is getting tighter. The people who act now are going to look back in a few years and be grateful they did. The people who wait are going to wish they hadn't. Think about the trajectory we're on. Government spending is out of control. Deficits are exploding. The political will to address these problems doesn't exist. Both parties, regardless of what they say, are committed to spending more money than the government takes in. That means more borrowing, more money printing, more devaluation of the currency. And that means gold and silver become more valuable in dollar terms, not because the metals are changing, but because the dollar is losing purchasing power. This isn't a political statement. It's a mathematical reality. You can't spend more than you earn indefinitely. At some point, the bill comes due. And when it does, the people who have positioned themselves in hard assets are going to be protected. The people who haven't are going to see their wealth evaporate. I want to leave you with this thought. The news isn't going to tell you when it's time to act. By the time they're reporting on gold hitting new highs and silver surging, the opportunity will have passed. The time to position yourself is when things are quiet, when most people aren't paying attention, when the smart money is accumulating and the crowd is distracted by other things. That time is now. You have a choice to make. You can continue doing what you've always done, trusting that the system will take care of you, hoping that your retirement accounts will be enough. Or you can take control of your financial future. You can educate yourself about what's really happening in the monetary system. You can allocate a portion of your wealth to assets that have stood the test of time. You can protect yourself from the risks that are building in the system. The guide I mentioned earlier, the one in the description, it's there for people who are ready to take that step. It's for American retirees with at least $100,000 in retirement accounts who understand that the world is changing and want to protect what they've worked their entire lives to build. And if you watch this video all the way to the end, which you have, you're eligible for an exclusive one-on-one educational web conference. No obligation, no pressure, just information that could be crucial for your financial future. It's only available to American retirees with at least $100,000 in retirement accounts, and you have to mention that you watched this video to qualify. The choice is yours. You can wait for the news to report what's happening, but by then it'll be too late. Or you can act now, while there's still time to position yourself ahead of the crowd. The smart money has already made their decision. The question is, what are you going to do?